Hello everybody, now we're going over chapter 3 from our textbook related to understanding financial statements, both income statement and balance sheet, and ultimately having a good grasp of the cash flow statements. So let's directly dive in. So first let's start with the income statement. It's known also as the profit loss statement, and the key idea is that revenues minus expenses, costs, should give you profits. That's the main idea, the formula in economics as well. Here we replace the word revenues with sales. Sales minus expenses equals profits. So the whole order sequence of the income statement will be based on this statement. We'll start with net sales. We will keep subtracting expenses until nothing is left but the net income. Along the way, like we said, we start with revenues. We keep subtracting first raw materials, cost of goods sold, various other operating expenses, marketing expenses, various other operating expenses such as administrative expenses, uh, depreciation expenses of that sort, and finally financing costs, financial expenses, including interest rates and tax payments. So the picture will end up looking like this, starting with sales, subtract cost of goods sold. This is an intermediate stop, after which again we subtract operating expenses and then another stop. Then we further subtract interest expenses, another stop, subtract income tax, and finally we get the last stop, which is the net income. When I say stop, I mean the subtotals to that up until that point. The best way would be to just look at an example. Consider this is the Home Depot company corporation income statement as of January 30, 2011, which is the fiscal year end for that company. So at that date, for the whole previous year, so starting from, I believe, January 31st, 2010 all the way up to January 30, 2011, for that one whole year period, the amount of sales were this amount. I assume everything is in millions, so therefore this number should be read as 67.9 billion, very close to $68 billion in sales. Subtract from that cost of goods sold, and the subtotal here, or the difference, will give you gross profit, from which you further subtract operating expenses, which total this amount, $17.5 billion, which will give you an operating income of $5.8 billion. But we still have more expenses to subtract, right? We need to subtract interest expense, followed by income taxes, and ultimately that would lead us to the net income. So net income is ultimately the figure that we want to obtain in our income statements when we construct the income statement. Along the way, I don't know if you guys realize it, but we've made three major stops. So the last stop was our destination, net income, the overall profit of the business over in a 1 year period. But what we did is, by just subtracting cost of goods sold from sales, we got our gross profit. And indeed, you can divide this number, gross profit, by sales to come up with what's called as gross profit margin. That's a profit margin, but it's a gross profit margin. If you were to further subtract operating expenses like we did here in these two, marketing and general administrative expenses, as well as depreciation expenses, what will come out of it will be operating income. And if I were to divide operating income by total sales, by that $68 billion figure, so 5,800 divided by 68,000 will give you that 8.5% operating profit margin, which is decidedly smaller than gross profit margin. And ultimately, once we subtract interest expenses and taxes, what we will come up with this figure, the net profit, which if we divide it by total sales will give us our net profit margin. This is the common sized financial statement in a sense. The benefit of calculating these percentages is the following. A $1 sale, we can keep track of it all the way until the bottom. So we know that every $1 sales in Home Depot will convert into a 4.9 cents of profit. All right. So this is a standard income statement table. The balance sheet is a little bit different. In the case of a balance sheet, we are looking at the financial position of the firm, a snapshot of the firm at a particular date. Now compare this with the income statement, which we just reviewed, which gives you the overall profit during a time range, which was a whole year. the past year, basically. Here in this one, it's just a snapshot of a particular date, at a particular date. How much assets do we have? What's the size of the liabilities and equity? And because this is really not an equation, to be honest. This is an identity. And rather than writing this identity like this, we should have rather wrote it as E is congruent to A minus L. Does that make sense? A is congruent to assets minus liabilities. So E, equity, is a residual account, and by definition, it is equal to assets minus liabilities, right? So this equation will always hold. If it doesn't hold, it's because of you did some discrepancies in your bookkeeping. Other than that, it should hold, right? Because it's an identity. All right, so when you look closely into the balance sheet, you just realize that it has the asset side. Like we said, total assets should better equal total liabilities plus equity. This is the liabilities and equity side. And along the way, you make some very interesting observations. One of the observations is that the assets are ranked in terms of their liquidity, as is liabilities, though liabilities is on top and equity is at the bottom on the right hand side. So the reason we do such a thing is because we want to calculate this animal here, which is the net working capital. And net working capital by definition is the difference between current assets, meaning liquid assets, minus current liabilities, liquid liabilities. What it means is these liabilities are coming, not these ones, short-term liabilities. Short-term liabilities, current liabilities are coming due soon. And how are we gonna pay for those liabilities? Well, it will be current assets which will cover those current liabilities. So we want to make sure that the management of the company on a day-to-day basis have to ensure that current assets are always above current liabilities. So this is what we call as working capital management. So this is one of the key decision-making processes that goes in a business, in a corporation. Working capital management, funding for short-term financing needs. So these are short-term financing needs over the next 30 days, and this is how our current assets is how we are going to cover for those. There's also within a firm, there's also long-term investment needs for fixed assets when we need to make an investment in a fixed asset, and they will be financed by long-term financing. So that would be a capital budgeting decision in a sense. All right, so that would give you the difference between working capital management versus capital budgeting decisions, which is ultimately the backbone of, alongside capital structure and other ideas, key ideas, 2 or 3 of them, the backbone of corporate finance, basically. Awesome. So current assets is the assets which can easily turn into cash, including cash itself, accounts receivable, and inventory. Notice that inventory are the products which are still in your possession, but soon you will sell them. Once you sell them, they convert into accounts receivables. So you already delivered the product to your customer, and the customer has 30 days or so to make a payment, and within 30 days they will turn into cash. So inventory is a current asset because soon those items in your inventory will be sold, convert into accounts receivable, and accounts receivables will in turn convert into cash. Awesome. Long-term assets include fixed assets like buildings and equipment, machinery, and so on. And there's also some other types of assets like prepaid expenses, like insurance or rent that you prepaid, and things of that nature. Patents, copyrights, and goodwill are all other types of assets, which are neither current assets, they are nor fixed assets. All right, on the other side of the balance sheet, the liabilities first. That is the main liability type, IOUs, right? So we split that into 2 categories, short-term versus long-term. Short-term debt, we usually call them as current debt. Depending on the classification that you have, it might be as low as 30 days, as much as 1 year for current debt, current liabilities. Long-term debt is anything which exceeds 1 year, basically. And that's the description. In the case of equity, we have different types of equity. Arguably, the most important one is common stocks and retained earnings, basically. There's also treasury stocks, paid-in capital, and some other stuff that you can also read it from our textbook. But retained earnings in particular is very important because it explains to you the relationship between the income statement and the balance sheet. And it is that any net profit that the company ultimately makes recorded in the income statement has to be somehow uh, used in two different ways. Either it should be paid to company shareholders, it will be distributed to company shareholders, or it can be retained in the firm. And retained for which reason? To grow the company so that it doesn't lose its competitive edge against all the other companies which are in business as well. So that's kind of the main areas of equity. So stocks and retained earnings, basically. So assets here on the left hand side, total assets should better equal to total liabilities plus total equity. Well, when I say that, I mean this has to be right. So because it is an identity, like we said, equity is just a residual account. It is just there to so that these two accounts balance, and it shows the profitable potential of the business, basically. So here is a standard balance sheet for this firm. As you can see, inside the balance sheet we have various columns, and the key idea is to compare the balance sheet with the previous year's balance sheet to see changes in different accounts. For instance, when you keep track of the cash accounts with what it was previously last year, and oops, sorry for that. Oh, there you go. What it was previously, we see that we lost a lot of cash. Now, $876 of cash, millions dollars of cash, has disappeared, and we want to explain it, right? It turns out that this turns out to be such an important task. It is the idea of the cash flow statements, basically. But obviously there has been changes in all these other accounts, and we need to keep track of all of them. Like we said, we can construct a third column which basically reflect on those changes. Now what you can do is all the changes in the liabilities and equity obviously will equal to all the changes in the total assets. And but we want to go one step beyond that, and like I said, the key number that we need to understand is this number, the cash. Why is it that our cash reserves went down, decreased by $876? So that's the subject of the cash flow statements. Along the way, obviously, we will also look at a lot of different financial ratios. Financial ratios are important because in terms of, it's easy to compare different companies using financial ratios. At the same time, it's also easy to compare our company with itself a year ago in time, or 2 years ago, right? Are we improving or not? And the second one was, compared to our competitors, is our position improving or not again? So that ratio is one of them. It's one of the most important ratios that you can look into when you look at the financial statements of a firm. It tells you how much of the assets is funded by borrowed money, basically. So that ratio, in a sense, is the percentage of assets that are financed by debt. As a formula, you can write it as that ratio equals liabilities divided by total assets. It's an indication of financial risk of the business. The riskier of the business is, it seems it is more profitable, but at the same time, it comes at a price, and the price of that is increased risk. So if you want to take leverage, if the firms take leverage all the time, the more leverage they take, the more profitable they will become for their shareholders, but at the same time, they have a significantly increased amount of risk. All right, net working capital, we talked about that, the difference between current assets and current liabilities, and we want that difference to be always positive. So we always have enough cash to cover our current liabilities, which are coming due soon, right? And yeah, so this is also referred to as working capital management, as we mentioned earlier. So how do we measure cash flows? How do we follow cash flows? So let's wrap up with that. So profits in the financial statements are calculated on basically accrual basis rather than cash basis. So the definition for accrual basis is that it is based on the principle of recording revenues when earned and expenses when incurred, rather than when the cash transactions takes place. All right. So now that we also make that distinction, it's time to look at the sources of cash and the uses of cash. So if we want to account for the difference in the cash account from what it was a year ago, we have to have a good understanding of where we spent the money and what type of sources of cash did we got during the year. Well, I guess the uses of cash is relatively straightforward. So we might use cash for paying the vendors, also investing in long-term fixed assets. So anytime there's an increase in an asset, it was probably financed by cash, so that will be a use of cash. And anytime there's a decrease in a liability, it was paid off, a liability was paid off by using cash basically. Increase in assets is a use of cash, decrease in liability is also a use of cash. Versus decrease in asset, for instance, if the inventory account is going down in value, it has to mean one thing, that those inventories were sold to customers, and as a result we got some cash, right? So decrease in assets is a source of cash, and increase in liability is also a source of cash, which means we borrowed new funds, and as a result we have more cash available now. So we can now put all of this into a nice picture, and just to organize our picture, what we can do is the following. We can categorize the type of activities that uses cash. Those activities will include operations, day-to-day operations basically, investment opportunities, investment in fixed capital, and finally financing activities where we try to raise funds or either we pay dividends. So the changes in the cash flows in those three activities will give us the net cash flow in a business. All right. We mentioned cash flows from operations, investments, and financing. And these three sources, once we have a good understanding and grasp of that, we should be able to account for all the changes in the cash account from one year to the next. And there's, if you want, you can give some recipes like this. But the key idea was to understand when an account increase or decrease depending on which side of the balance sheet it is, it will have an implication for the use of cash or as a source of cash basically. So you can read these from your textbook, and once you start with net income, that's one way to calculate cash flow from operations. You start from the net income account, and then by making some modifications to that account, ultimately you can at the bottom, on top you start with net income. With all these modifications, you can at the bottom come up with the cash flow from operations figure. And here is an example of such a thing. Net income for our company, if you remember, was $3,338 from Home Depot, and as a result the cash flow from operating activities were this much. So net income is a cash income inflow versus all these other cash outflows, and this is the net. So which is so far looks pretty good. Cash flows from investing in long-term assets can also be accounted for, and we can, just looking at the financial statements for Home Depot, we realize that Home Depot spent $1.1 billion on fixed assets and $159 million on other assets. So that's a cash outflow basically that we need to account for. So, and then ultimately we can bring together those cash inflows and cash outflows. I'm not saying this is easy. Usually students, they struggle the most in this topic, but ultimately that's how it's done. And so this way we are able to come up with the overall cash flow. This picture is related to financing cash flows, the third component of the cash flows, which you guys can follow up. Make sure you compare it with the balance sheet numbers and that you can match those numbers. And ultimately, when you put together these three pieces, like I said, the operating activities, the investing activities, and the financing activities all together, that should give you the that should give you the overall number, which was, well, I need to go back all the way to the beginning, but 4236 minus 1285 minus 3827, those three numbers combined should give that discrepancy in the balance sheet. Do you remember? Let me go all the way to the beginning to remind you of this one. So remember, our goal was to account for that $876. So the cash flow statement does that basically. It accounts for all the changes in the cash flow. So all you need is just to add up these three numbers and get the desired result. Income taxes are also relevant for our purposes because it's one of the items in the income statement. So how do corporations compute that? And what matters is the marginal tax rate, right? So that's an important concept. So when a company has a certain sales, you come all the way up down to that taxable income figure. At that level, you need to figure out what is the tax amount based on that $16 million. It turns out that we have some tables. These are some, first, the company needs to decide on which tax bracket it's in. So in our case, $16 million will fall into this bracket, the 35% tax bracket. But at the same time, it has to also pay an additional surtax because $16 million also falls into this bracket. So making these modifications can give you the desired result for the tax liability for the firm. Subtracting it from, subtracting it from the taxable income, that tax liability that you computed will give us the net income. Awesome. And you can read our textbook for the details. So here are the keywords that we talked about in this chapter. Well, some of them. There's a lot of keywords, as you guys can see, and some more list. But this is mostly based on what you guys learned in your financial accounting courses. Financial reporting, basically. And this will be the backbone where we will build finance based on. So in general, finance courses are built up on 3 courses. What are those? Economics, um, both micro and macroeconomics, accounting, mostly financial accounting, but also to a certain extent managerial accounting, and finally, I claim statistics. It turns out that statistics, some knowledge of statistics will turn out to be crucial in our understanding of finance as a new discipline that you guys are trying to grasp, right? So this will turn out to be very important. So make sure you review those concepts from accounting and ultimately economics and statistics to have a good understanding of these finance topics. So that will conclude my presentation related to chapter 3, financial statements, and the cash flow statements in particular related to a firm. In the next presentation, I will go over financial ratios, which I mentioned during this presentation a little bit while I was talking about the debt ratio. The key idea of financial ratios is the fact that they are standardized, and by looking at the financial ratios, we should be able to not only compare companies operating within the same industry, but at the same time compare a company with its own itself in a previous year. So this way we can both see if our company is improving across time, but also if our company is improving with respect to other firms operating in that same industry. So it will turn out to be a very important concept. I'm looking forward to see you guys in that video.